Hello, I am Brooke Fouts with Vintory. I'm here to talk today about vacation rental inventory, core financial metrics. So really excited about this. This one I'm really passionate about and really excited to talk about it today. So let's just jump in. All right. So first off, new inventory is the greatest way to grow your top line revenues, grow your bottom line profits, and build your net worth. And over the next couple of slides, I'm going to talk about that here and prove my case. First off, if you think about it, there are really three levers of growth you can do to really control the top line revenue, right? You can increase your rate, you can increase your occupancy, or you can increase your inventory. But increasing your inventory has the greatest impact. So let's talk about a typical example of a typical vacation rental manager. And let's say you go out there and you increase your rates by 5%. That comes out to $142,000 in this example, $142,000 in top line revenue increase. Now, let's say you go out there, you increase your occupancy by 5%. That has a $219,000, lift to your top line revenue. The thing with these is there's an upper limit. There's a maximum amount you can do. You can't get 100%, more than 100% occupied. And obviously you can only push your rates, so far. But let's say you go out there and you do the equivalent lift. And we've surveyed many of our partners and we ask, what's the equivalent lift of 5% rates, 5% occupancy? And the number we were always told from our partner base was comes out to about one property per month. So if you go out there and you add one property per month, that's it, just 12 over the course of a year. Anybody could do that. That makes a $854,000 top line increase, which is 4 to 6 times of what these other lifts are. And the best part, there's no limit to what you can do. You can continue to add inventory as much as you want. So again, I would argue there is not a better lever you can pull than actually going out there and adding inventory. All right. So when I go out there and I talk to many of our partners, I've always asked this question. I said, what falls to the bottom line in net income or net profits across your portfolio? And then you divide it on a per property basis. And the answer is always about 10% of the gross booking revenue. So it doesn't matter if you're a property manager like I was in Ocean City, Maryland, charging 13 to 16%, or if you're one of these property managers that, is charging 45%. Net, what usually falls to the bottom line in net income or EBITDA or net profits, whatever you want to call it, is about 10% of the gross booking revenue. Now, this is owner rent. This is before taxes and fees. This is what you're paying your owner on. Now, according to Key Data Dashboards, the average gross booking revenue is about $50,000. So in this example, we're going to come up with $50,000 in gross booking revenue. 10% comes out to about $5,000 in net profit per year. Now, this is the key point. You don't keep a property in your rental program for 1 year. You keep a property in your rental program for multiple years. So how do you calculate the lifetime of that property? I mean, I remember when I had my company Vantage, we had some properties that churned in the first year. We had other properties. I mean, I started that company 16, 17 years ago. The company's been sold twice, and there's still properties in that rental program that have not left. So properties stay along. But how do you calculate the lifetime? Well, it's a simple formula. You take 1 divided by your churn. Brooke, what the heck is churn? Churn is what percentage of your inventory do you lose in a given year? And the average is, again, asking over 500 different companies in our industry, the average is always about 10%. Now, some people might be a little bit higher, some people might be a little bit lower, but on average, it's about 10%. Jacoby Olin with C2G Advisors. He's done more mergers and acquisitions than anybody in this space. He confirms that the number is usually between that 8 and 10%. So we'll use 10%. So again, you take 1 divided by 10%, you get a 10-year lifetime. So you go out there, you're making 5,000 per year. You're going to keep that property rental program on average 10 years. That means your lifetime value is 50,000. And you'll notice convenient here, the 50,000 in gross booking revenue, 50,000 in lifetime value. So here's a hack alert. Assuming you fall within industry averages within your churn rate and then your net profit margins, your lifetime value is equal to your gross booking revenue. So this is a real easy formula. You go out there, you sign a property doing 75,000 in gross booking revenue, you can assume that you're going to make $75,000 in lifetime profits. You go out there, you sign a property doing 100,000 in gross booking revenue, you can take it to the bank, you're going to make $100,000 in lifetime value. Now, I would actually argue these numbers are a little bit light. Why? Because what happens over a 10-year lifetime? Is that the revenue is going to stay flat? No. Over time, they're going to go up. I've got a property in Bethany Beach, Delaware. It did $80,000 in gross booking revenue last year. If you look 5 years ago, it was doing about 40 or 50,000. So we know it's going to go up over time. So again, this is just a rule of thumb. It just gives you kind of a quick rule of thumb. So next time you take that call that's coming in and that homeowner has $100,000 a year gross booking revenue, you better treat that lead like gold that it is, because it's worth $100,000 to you in net profits over the next 10 years. So treat it really well. Make sure you're responding quickly, and we'll talk about that later. All right. So now we've established that obviously there's this great cash flow from these properties, but if and when you decide to sell your company, you are going to get a check for every one of those management contracts because here's the thing, the true value of your management company, it's those management contracts. It's not your beautifully wrapped trucks. It's not your guest database. It's not your beautiful office. It's not your cool, whatever swag you have. The true value of your management company are those management contracts. So how do you calculate the value? Now, there's multiple different earnings, multiple different methods. I'm going to let Jacoby Olin, the best in the business, let him kind of describe it. But the most popular method, and again, we'll keep this really, really simple, high level. The most popular method is called the multiple of earnings. And it ranges anywhere between 3.5 and 6 times your earnings or your EBITDA or your net profits. So in this example, we're just going to use an average of 5x multiple. So if we use that same example from before, $5,000 in EBITDA or net income or profits, you have a property that's worth about $25,000 per property. So you go out there, let's say in the next couple of weeks, you sign up 10 properties. You just added $250,000 in net worth to your company. Let's say you really crush it over the next year. You add 50 properties. You just built $1.25 million in equity. And let's say you really crush it over the next year or two and you add 200 properties. You now have a company that's worth an extra $5 million than where it was before. Again, there is not a better lever that you can pull than adding inventory to building your net worth and also obviously your profits. So to further confirm this point, I actually had my team go out and look at some public comps, and this is what we found. If you look at the Wyndham acquisition by Vacasa a couple years ago, they paid $18,000 per contract. If you look at Vacasa's own investor deck, July 2021, they paid $21,000 per contract. It's not just in the US. You look at the UK. Sykes Holiday Cottages was bought by Vitruvian Partners, private equity firm. They paid $27,000 per contract. But look at this comp right here. C2G Advisors, again, Jacoby Olin, he did over $250 million for the M&A last year. What he did is he took all that mergers and acquisitions, all those deals that were done, divided by the number of properties that were in the portfolios that were sold, and the average comp came out to $29,000 per contract. That is the best comp of them all. Now, again, it depends on your EBITDA, it depends on your profits, depends on how fast you're growing, and all these other things. But if you take a step back and look at a whole across all that inventory that was sold, the average contract was $29,000. Again, that is probably the best comp of them all. And then check out this one right here. You look at Turnkey, Vicasa's acquisition of Turnkey a couple years ago, they paid $103,000 per contract. Now, much of that was in stock, and I'm sure the people over Turnkey are wishing they got it in cash. All right. We've established all that. Now let's get into these really cool financial metrics. So let's get started. So first thing, I did a little poll, on LinkedIn, and I asked them. I said, "Hey, if you're a vacation rental manager, what would be the maximum willingness to pay for a new management contract if you knew that property was going to do about $75,000 in first year top line revenue?" We had 36% say only 1,000. We had 23% say 5,000. We had 30% say 7,500, which is typically the first year margins. And we had 11% say 29,000, which is the average M&A purchase cost out there. I thought that was kind of interesting. What I was really surprised of was really, if you look at it, you had about 59% of the people would only pay 5,000 or less, which I think is a mistake because this property is going to throw off cash flow. If I was going to drive out to your house and give you an annuity paying you $75,000 over the next 10 years, would you give me 7,500? But would you give me $7,500 right now? And if you say no to that, I think you're absolutely crazy personally, but that's what it comes down to. So, but we do have, again, we had at least 41% of the people here agreed that they would pay $7,500 or higher for that property. So again, we'll just set the stage with that. All right, so let's kick in. So the first thing we're going to talk about is CAC. Brooke, what the heck is CAC? CAC stands for customer acquisition costs. Otherwise, how do what is the cost to generate a new customer? So if we go out there, let's do a little example. If you were going to go out there and let's say you send out 2,000 letters, this could be a combination, an average of maybe you do some postcards that are $1, maybe you're doing some pretty brochures, which are $4, and you're doing some handwritten letters, which are $4. Let's just say on average, it costs you about $250 per letter that you send out. That means you just spent $5,000. Let's say you get 0.5% response rate. According to the Direct Marketing Association, that is the average response rate for direct mail, which gets you about 10 calls. And let's say, after you get all those calls, you weed them through, you get some tire kickers and things like that, you end up closing 10% of that or one contract. Well, let's see what you got here, math major. What's your CAC? Pretty simple, right? Your CAC is $5,000. So again, we're going to use this as our example going forward. All right. So check this out. So using that example of a property doing 50,000 in gross booking revenue and 5,000 in first year net profits, or it comes out to $416 a month, you can see we have this cash outlay of $5,000 to acquire this homeowner, but we're making this annuity of $416 in net income or profits per month. So this is what it looks like for that first year. Now, if you look at it, this is on like a cumulative basis. After you can see that over this entire year, it takes us until the 12-month mark to get to that break-even point. We call this our CAC recovery, customer acquisition cost recovery. And this is usually in months. So this is a critical metric, and we always like to try to get our CAC recovery right at about that, that 1 year mark. Because if you think about it, let's look at the next slide. You have this $5,000 outlay, to get this new customer. Year one, all you're doing is covering your costs. That's all you want to do is cover your costs to acquire that customer because we know if you have a 10% churn or thereabouts, that you're going to keep this property in your rental program for 10 years. So if you think about it from, year one is break even, year two through year 10 is all profits. And that's just it's just compounding. And you can see we spent $5,000 and we've netted 45,000 when it was all said and done. Now, what I did is I went out there and I said, you know what, just how would that compare to investing in, let's say, like the S&P index? If you're not familiar with the Standard & Poor's index, 500 index, it's the 500 largest companies in America. It beats 86% of all actively managed mutual funds out there. This is like the gold standard where you want to put your money typically. It's what I always tell my kids, just invest in the S&P 500. Don't worry about anything else. But anyways, if we were to go in there and invest that same $5,000 in the S&P index, which again is the gold standard, and we had a 12% return, which is actually a little bit higher than it actually does, we would only have $15,000 versus our $45,000. Just think about that. That's 3x. We would actually make 3x by investing in acquiring new inventory versus the S&P index, which is considered the gold standard. So again, I'd argue there's not a better ROI out there. But wait, there's more. Remember, that contract has value. We know from Jacoby Olin, the average contract is worth $29,000. So that really can build on top of that. Now, it ultimately depends where you sell it, but you get the point here. So again, inventory is super, super valuable. All right. We're going to shift gears a little bit and talk about unit economics. So the definition is pretty simple. Can I make more profit from my customers than it costs me to acquire them? And there's a couple different metrics that we're going to talk about. The first is ROI, otherwise known as return on investment. And the other one is called LTV to CAC. So lifetime value to customer acquisition cost. So we have this lifetime value, this annuity, this revenue, and this income of profits that is coming in. And then we also have our customer acquisition costs to get them. So we'll talk about both of these in a little bit. So first off, the return on investment for every dollar I invest in inventory acquisition, how much do I make in profit? We have a first year ROI. We're looking for a 1.0 return. We really just want to recoup our expenses in year one because, again, we know we're going to keep this property in a rental program on average 10 years. So we know our profits are going to be from year 2 through year 10. Now, our 5-year ROI, what we're looking for, our target rate is usually about 4x. But enough of that one. The one I like the most is LTV to CAC ratio, which again is the lifetime of profits of a property versus the cost to acquire them. This is the holy grail of all inventory acquisition metrics. If you were only going to track one metric for inventory acquisition, this is it. Put it on your dashboard, put it on your KPIs. And the reason I like this is because it takes into account all the key factors. It takes into all the key factors of profit margins. It takes into account churn, and it takes into account acquisition cost. So again, if we were to look back at our example from before, our CAC was $5,000. But again, if we had a lifetime value of 50,000, so you can see how that just multiplies and how big that is, how those profits are. So in this case, our LTV to CAC ratio is going to be a 10 to 1. So again, a 10x return on this. So again, this is the holy grail of all metrics. So again, if you're only tracking one metric, this would be it, that LTV to CAC ratio. Here's the thing. If you have a solid LTV to CAC ratio and you have a systematic way of generating new properties, guess what? Back up a truck of cash and invest it back into your business because you have a money machine. You are putting dollar bills on one end and out the other end is pumping out 50s and $100 bills. Plus, you will get a big check if and when you decide to sell your business. Well, that's it. Thank you very much. This was a very brief session on the vacation rental inventory core financial metrics. I hope you appreciate it. Again, my name is Brooke Fouts. If you have any questions, you can email me, brooke@vintory.com. If I've written 3 books on vacation rentals in the industry, we just launched a new one called The Ultimate Tech Stack Guide. If you want any of these books, feel free to email me, brooke@vintory.com. I'm happy to mail you one in person. I'll send it directly to you. So thank you very much. If you have any questions, email me. Thanks. Bye.